Financial literacy is one of the most essential life skills, yet it remains an area where confusion runs rampant, especially when it comes to understanding financial terminology. Whether you're browsing your credit report, reviewing investment documents, or simply trying to make sense of a loan agreement, you'll likely run into terms that can be misleading or counterintuitive. Misunderstanding these terms can result in costly mistakes, poor financial planning, and missed opportunities. That's why decoding financial jargon isn't just helpful, it's critical. In this video, we'll explain the top 10 most misunderstood financial terms in simple, plain English, helping you make smarter decisions and avoid common pitfalls in your financial journey. 1. APR, annual percentage rate. Many people confuse APR with interest rate, but they're not the same. APR stands for annual percentage rate and includes not only the interest rate on a loan or credit card but also any associated fees or additional costs, such as origination fees or points. For example, if you take out a mortgage with a 5% interest rate but pay thousands in fees, the APR may be 5.3% or higher, giving you a more accurate picture of what the loan will actually cost over a year. When comparing financial products, looking at the APR, not just the interest rate, gives you a clearer understanding of the real cost of borrowing. 2. Amortization. Amortization sounds complicated, but it simply refers to the process of spreading out a loan into a series of fixed payments over time. Each payment includes both principal, the amount you originally borrowed, and interest, the cost of borrowing. In the early years of an amortized loan, like a mortgage, most of your payment goes toward interest. Over time, more of your payment goes toward reducing the principal. Many people don't realize this, which is why they're surprised to see how slowly their loan balance decreases at the beginning. 3. Compound interest. Compound interest is often touted as the eighth wonder of the world, yet many people misunderstand how it works. Unlike simple interest, which is calculated only on the original amount of money, compound interest is calculated on both the original principal and the interest that accumulates over time. This means your money earns interest on your interest. While this can work powerfully in your favor in savings and investments, it can work against you in debt, especially credit cards and payday loans, where unpaid interest keeps piling up. 4. Credit utilization. Credit utilization refers to the percentage of your total available credit that you're currently using. For instance, if your total credit limit is $10,000 and your current balance is $3,000, your credit utilization is 30%. This term matters because credit utilization is a key factor in determining your credit score. Many people mistakenly think as long as they make minimum payments on time, their credit score will remain strong, but high credit utilization, even with on-time payments, can hurt your score. Experts generally recommend keeping utilization under 30% for a healthy credit profile. 5. Net worth. Net worth is not your income, and it's not just what you have in your checking account. It's the total value of all your assets, like cash, stocks, real estate, and retirement accounts, minus all your liabilities, like mortgages, student loans, and credit card debt. Many people earning six figures assume they are financially strong, but if they owe more than they own, they have a negative net worth. Understanding your true net worth gives you a much clearer picture of your financial health than focusing on income alone. 6. Liquidity. Liquidity refers to how quickly and easily you can convert an asset into cash without losing value. Cash is the most liquid asset because you can spend it immediately. Real estate, on the other hand, is much less liquid because it may take months to sell, and you might not get the full market value in a rush. Many people confuse value with liquidity. Just because you own something valuable doesn't mean you can use its value in a financial emergency. That's why maintaining some liquid assets, like a savings account or money market fund, is essential for financial flexibility. 7. Diversification. Diversification is one of the most misunderstood and underused strategies in investing. It means spreading your investments across a variety of assets, stocks, bonds, real estate, etc., to reduce risk. The key idea is that not all investments will perform the same way at the same time. Many people think they're diversified if they own several different stocks, but true diversification includes multiple asset classes, industries, and even geographical regions. Failing to diversify means you're more vulnerable to losses when a specific market segment declines. 8. Capital gains. Capital gains are the profits made from selling an asset, like stocks, real estate, or even collectibles, for more than you paid for it. There are two types: short-term, assets held for 1 year or less, and long-term, held for more than a year. The difference is important because they're taxed differently. Short-term gains are taxed at your regular income rate, while long-term gains usually receive a lower, preferential tax rate. Many people overlook this and end up with a higher than expected tax bill when they cash out investments too early. 9. Margin. Trading, on margin, means borrowing money from your broker to buy more stocks than you could with your own cash. While this can amplify your gains, it also increases your losses if the market moves against you. Many new investors misunderstand margin as free or low-risk capital, when in fact it's essentially a loan with interest and strict repayment requirements. If your investment loses value, your broker may issue a margin call, requiring you to deposit more money or sell assets at a loss, potentially turning a small decline into a major financial setback. 10. Inflation. Inflation is commonly understood as rising prices, but many people don't grasp its deeper implications. Inflation means that your money buys less over time, eroding purchasing power. A modest inflation rate, around 2% per year, is considered healthy for economic growth, but even that small rate can dramatically affect savings over decades. If your savings or investments aren't keeping pace with inflation, you're effectively losing money. That's why keeping large sums in low-interest savings accounts can be risky over time, especially for long-term goals like retirement. Understanding financial terms is no longer optional, it's vital for anyone who wants to achieve long-term financial stability and success. Misunderstood jargon can lead to poor decisions, hidden fees, and a general feeling of confusion around money. By demystifying these top 10 financial terms, APR, amortization, compound interest, credit utilization, net worth, liquidity, diversification, capital gains, margin, and inflation, you gain more control over your financial life. With this knowledge, you'll not only make better money moves, but you'll also build confidence to navigate a financial world that often seems built to confuse. Remember, the more you understand the language of money, the better equipped you'll be to grow and protect your wealth.